Hello and welcome to our webinar hosted by the Burges Salmon Pensions Practice. This is a reminder that the webinar is being recorded. I will now hand over to your Burges Salmon host today, Richard Knight. Over to you, Richard.
Hello, I'm Richard Knight, Head of Pensions at Burges Salmon, and a very warm welcome to our webinar, which is on current considerations in pensions regulation. This webinar is part of a series of webinars and podcasts we're providing in respect of pensions. I'm delighted to be joined today by David Fairs, who is the Executive Director for Regulatory Policy, Analysis and Advice at the Pensions Regulator, and Clive Pugh, who has led our pensions regulatory team at Burges Salmon for the last decade or so, having himself previously worked at the regulator. Now, obviously, we're each in different locations at the moment, but the idea is that the three of us are going to spend some time in conversation discussing some of the hot topics of the moment. So to kick us off, David, the last few months must have been incredibly fast moving for you, with lots of policy announcements and advice to the industry. Please could you bring us right up to date on TPR's position with regard to the phasing out of lockdown? How should employers and trustees be approaching that in the context of their pension schemes?
Thank you very much. It's probably worth reminding ourselves of the actions that we took when COVID broke. And as a regulator, we took actions under three broad headings. Firstly, we were really concerned that members took some time to make decisions that they could potentially regret. So for those individuals thinking about transferring benefits or coming up to retirement, we wanted them to take a step back, think very carefully about what they were doing, and if appropriate, seek guidance or advice. And we directed those people to the Money and Pension Service. So we've worked very closely with the FCA and the Money and Pension Service on providing guidance for those members facing difficult decisions. Also very much alive to the prospect that members may be subject to scammers. So again, we put out guidance jointly with the FCA and the Money and Pension Service, directing those individuals to the Scam Smart website to get them to think very carefully. The second of those key issues that we were thinking about are operational issues. We were really concerned that pensions in payment continue to be paid, beneficiary payments tended to be paid on time, but also those contributing to pensions continue to save and that their contributions were invested promptly. So in order to help that process, we provided a number of easements, and those easements will expire at the end of June unless we extend them. So we put in place a number of easements. So where trustees would normally report to us, we provided some relaxation around that and said that where there were breaches, we would take a proportionate response. So today we're announcing that we're going to turn back on some of those reporting requirements. We have been incredibly impressed about how administrators and the industry have responded to the challenges of working remotely. And so we think it's appropriate now that we actually turn back those reporting mechanisms so we get a good intelligence of what's happening in the marketplace. We will continue to take proportionate action where there are delays through this crisis. And the last area that we provided some easement around was in terms of short-term financial pressures that organisations had. Where it was appropriate to do so, we allow trustees, if approached by an employer, to defer or suspend contributions for a period of up to 3 months. Now, we didn't provide a blanket easement. We did want employers to provide information to trustees so that they could decide whether it was appropriate to give those easements. And we wanted the pension scheme to be treated fairly in terms of any further actions that the employer may be considering. We are going to provide further detail around how that operates. So we're allowing trustees to continue to extend a deferral or suspension of contributions if it's appropriate to do so. But we have seen that in some cases, a relatively small number of cases, that in some cases, trustees were being overly accommodating in terms of requests to defer contributions, and in other cases they were perhaps being a little bit too tough when it would be appropriate and right to provide those easements to employers. So we're providing greater clarity today around when we think it's appropriate for trustees to give that suspension or deferral of contributions to employers.
Extremely helpful in respect of that update for the ongoing position on deferrals. We also have in mind the move towards employers paying an amount for the furlough payments, and that may give rise to a balancing issue. Do they pay towards furlough? Do they pay towards contributions for the scheme? We wondered what regulatory issues come from that, and also, is there any guidance that will be coming to help trustees?
So throughout this crisis, automatic enrolment duties have continued to apply. So we do expect employers to contribute to the pension scheme. For furloughed employees, recognising the support and help that government was providing to employers under the job retention scheme, we did allow that employers, where they were paying more than automatic enrolment minimum, to reduce contributions down to that level. But to stress, we did still expect employers to comply with their duties. But in the job retention scheme for furloughed employers, those were contributions, employer contributions were being reimbursed from government. As you rightly point out, the job retention scheme is changing, and employers will be expected to take on some of the payments to employ furloughed employees and to pay contributions. So we recognise that that might put financial burden on some employers. The right thing to do in those circumstances is for employers to contact their pension provider, and if they have some financial pressures, to agree a payment plan with their provider. But to stress, automatic enrolment responsibilities do continue. We do expect employers to comply.
Thank you. And I suppose a related issue to that is sort of, the coming months and the years ahead. We've seen in the press the difference between potential L-shaped recovery, a potential V-shaped recovery. When we talk to trustees, they think to themselves that provides quite a wide range of economic factors to take into account, a lot of uncertainty. We wondered how the regulator is approaching its guidance having regard to the different types of recovery that may be coming in the future, and if there are any sort of tips for trustees about how they might approach that variance.
So we do recognise that there is a lot of economic uncertainty, and that's particularly challenging for those pension schemes that have got actuarial valuations this year. So we did provide some guidance in our annual funding statement to try and guide employers in the way that they should approach this. And there are really a number of different elements to this. There are how trustees should go around setting technical provisions, taking account of the fact of what's going to happen for long-term interest rates, and what will happen in terms of investment returns on the assets that they hold. And as you say, that very much depends on the type of recovery that we have. Within our annual funding statement, we suggested that it would be right for trustees and employers to think of a range of scenarios and to look at the funding of their plan under each of those different scenarios. So actually in 2, 3, 4 years' time, when they look back at this period, they haven't set technical provisions and recovery plans in a way which each party regrets. So actually, if recovery is quicker and better than they'd anticipated, then actually the recovery plan reflects that. And actually, if their sponsoring employer is struggling, then trustees also take account of that. And clearly within that, the real challenge is what happens to their particular sponsoring employer, how quickly it will come out of lockdown, how quickly profits will recover, how quickly cash flows will return. Now, there are some employers who are coming through this crisis in remarkably good shape. They've continued to be profitable and strong cash flows. And for those employers, we do expect them to support and contribute to the pension scheme just as they were. But I think for many employers, there are some challenges, some very real challenges. And each sponsoring employer, I think, is going to come out of this crisis in different shape. Just because a business was profitable before lockdown, it may not be profitable and strong cash flows thereafter. we're all seeing, I think, as lockdown, that our buying habits are changing, and that might then have an impact on particular employers. So I think trustees have got to look at, the general economic recovery and how that will impact their scheme, but they've also got to take a very close look at their sponsoring employer. And we've suggested in our annual funding statement that they work very closely with the sponsoring employer, the scenarios that the sponsoring employer is looking at in terms of its own financial recovery and some of the risks and challenges that it's going to encounter, and develop their plans in conjunction with the employer.
On that, we've seen a rise in trustees looking into side agreements, sort of profit share agreements or other form of trigger agreements that supplement the technical provision recovery plan. We wondered if you're seeing a rise in that in the broader universe of schemes that you work with, and whether there are any thoughts or comments in that regard.
So where employers are being given easements by trustees, then we do say that we want that to be legally enforceable, and we're seeing very many different shapes of how that looks. Clearly, it's down to trustees and employers to work with their advisors, with legal advice, to ensure that those agreements are appropriate.
I suppose no one is like the fast movement that the Treasury had at the start of this. There was also that quick guidance from the regulator providing flexibility, providing a transparent way forward. And I know that the industry was very grateful for that. A few people, when they come and seek advice from us, they say, well, is there a chance that if we apply some of these relaxations, we might be in technical breach of legislation, or there might be a more formal, more substantive breach? I just wondered how you feel about that potential, the different types of breach that exist, and the approach of the regulator, and if there's any sort of development of approach that may be coming ahead on that.
So we've tried to be really clear in our guidance of our expectations of trustees and employers in this crisis. And we today again have said that we will take a proportionate response. Clearly, where we're setting out that employers have to comply with automatic enrolment duties, if they're not complying with those duties, then we will take appropriate action. But we'll take it proportionally. So if people are deliberately trying to evade their responsibilities and duties, then we'll take action against them. We recognise that where information flows are late, where trustees are struggling to get annual benefit statements on time or accounts completed, then we are going to take a proportionate approach. So with the announcement that we're making today, where we're turning back on reporting requirements, that's to improve our understanding of the challenges and difficulties that particular schemes are having. It doesn't mean that in every case that we will take action where there are delays or difficulties in providing information. We've tried today to set out very clearly where we're tolerant of those delays, and where we'll provide some easement, but also where we think it's right that actually trustees do actually fulfil their duties. We do think it's important that pensions get paid, that beneficiaries are paid quickly, and that contributions are invested quickly.
And David, if I may, I'd just like to ask you a couple of questions that aren't related to COVID-19. I mean, first of all, please could you tell us where we are now in relation to super funds, and also whether TPR is broadly positive in respect of capital provider options, subject of course to them having an appropriate risk profile?
So we do see some benefits from super funds, the ability to scale up the provision of some services, access to investment advice and investment opportunities. So we do see that there are some benefits from super funds, but we also recognise that there are some new risks and new challenges. So we have on our website, for those organisations that are thinking of coming into the market and operating as a super fund, we've provided guidance on what our expectations are around people who want to operate super funds. And we have a number of super funds that approached us and voluntarily sharing details of how they intend to operate. We are in this process of updating our guidance, and we'll publish an update to our guidance because what we are beginning to see are not only super funds entering the market, but some innovative financial structures. And again, I wrote in a blog relatively recently that where organisations are thinking of taking advantage of those innovative structures, they should come and talk to us and explain how they work so that we can understand how they operate. And again, our guidance will be updated to set out our expectations around those new types of innovative structures. We are very much in favour of innovation within the marketplace, but we have to ensure that actually savers' benefits are protected.
No, thank you. And David, is that guidance likely to be within a matter of weeks? Is it something we can expect soon?
It will be in the next few weeks, yeah.
Okay, thank you very much. I suppose finally, from my point of view, just thinking about members, you mentioned earlier about the possibility of members being scammed, particularly at this time. Have you seen scamming activity increase, and are there any new considerations there for trustees and members to take into account?
So I think whilst there has been an increase in scam activity and people taking advantage of the volatility in the markets and the uncertainty that people have, actually in relation to pensions, we haven't seen an uptick in scam activity. Clearly, we reacted very quickly to ensure that we worked with our partners, the FCA and the Money and Pension Service, to put out guidance to people to make them aware that this is exactly the type of environment where scammers look to operate, and try to indicate to them the sort of signs that they should be aware of to point people to the Scam Smart website, but also for individuals who are thinking about taking a transfer value. We've provided a template letter which we want trustees to send to members thinking about transferring, so that they can think about the risks, including risks of scams. And we're quite hopeful that all the messaging that we've done seems to be paying off, because we haven't seen that increase in scam activity in relation to pensions in any case.
That's good news. Well, thank you so much, David and Clive. You've given us some really interesting insights there, and we appreciate you giving us your time, David, particularly at such a busy time. Thank you for bringing us right up to date.
The webinar has now concluded and will now end. Thank you very much for joining.